Hey everyone, welcome back to the channel. Today we're talking about something huge, something that affects all of us, but that most people have never even heard of. What if I told you that the real danger to the world economy isn't tea in the stocks you see on the news, or the crypto that everyone's buzzing about? What if the real threat is something far, far bigger, hidden in plain sight? I'm talking about a $600 trillion ticking time bomb that could make the 2008 financial crisis look like a minor speed bump. Stick with me, because what you're about to hear is going to change the way you see the world of finance forever. Let's start with a number that's almost impossible to comprehend. $600 trillion. That's a 6, followed by 14 zeros. To put that in perspective, the entire global economy, the value of every single good and service produced by every country on Earth in a year, is about $105 trillion. So, we're talking about something nearly 6 times larger than the entire world's economic output. This is the estimated size of the global derivatives market. And here's the kicker. Back in 2008, right before the big crash, this market was about 10 times smaller. So, what happened? Did we learn our lesson? It seems we did the exact opposite. So, what exactly are derivatives? The name sounds complicated, but the basic idea is actually pretty simple. A derivative is just a financial contract. Its value is derived from an underlying asset. Think of it like a bet. You're not buying the asset itself, like a stock or a barrel of oil. Instead, you're making a bet on what the price of that asset will be in the future. For example, a farmer might use a derivative to lock in a price for his corn harvest months before it's ready, protecting himself from a sudden price drop. An airline might use one to lock in a price for jet fuel, protecting against a price spike. On the surface, they're tools for managing risk, and in many cases, they work exactly as intended. They provide stability and predictability in a volatile world. But that's only one side of the story. The other side is where things get dangerous, because derivatives are also used for speculation. Big banks, hedge funds, and traders can use them to make massive bets on the direction of markets, currencies, or interest rates. And the key word here is leverage. With a very small amount of upfront cash, you can control a huge position. It's like putting down a tiny deposit to control a massive piece of financial real estate. If your bet pays off, you can make an astronomical profit. But if your bet goes wrong, the losses can be equally astronomical, often far exceeding your initial investment. This is where the web starts to get tangled. One of the most famous critics of derivatives is none other than Warren Buffett. Years before the 2008 crisis, he called them financial weapons of mass destruction. He warned that they were time bombs, both for the parties who dealt in them and for the economic system. He wasn't being dramatic. He saw the inherent danger in a system built on layers of complex, interconnected bets, where nobody truly knew who owed what to whom. And in 2008, his warning came true in the most spectacular fashion. Let's rewind to that fateful year. The collapse of the housing market was the spark, but derivatives were the gasoline poured on the fire. Investment bank Lehman Brothers was a huge player in the derivatives market. When it went bankrupt, it was like pulling a critical Jenga block from the tower. Suddenly, everyone who had a contract with Lehman, who was counting on them to pay up on their bets, was left holding an empty bag. Panic spread like wildfire. But the real near miss, the one that almost brought the entire global financial system to its knees, was AIG. American International Group was one of the world's largest insurance companies. They had sold mountains of a specific type of derivative called a credit default swap, or CDS. Essentially, they were insuring other banks' risky mortgage bets. When those bets went bad, AIG was on the hook for billions upon billions of dollars it simply didn't have. The US government had to step in with a colossal $182 billion bailout. Why? Because if AIG had failed, it would have created a domino effect, taking down every major bank it had insured and freezing the entire global credit system. Your ATM might have stopped working. The world economy was staring into the abyss. So you would think that after a near-death experience like that, we'd have reined this stuff in, right? That regulators would have dismantled these weapons of mass destruction. Well, you'd be wrong. In fact, the opposite happened. After a brief dip, the derivatives market didn't just recover, it exploded. It grew from around $60 trillion before the crisis to the $600 trillion behemoth it is today. We didn't learn our lesson. We doubled down. Banks are bigger, the system is more interconnected, and the derivatives are even more complex. So how can something so massive be so hidden? It's because much of this market operates over-the-counter, or OTC. This means trades happen directly between two parties, like two big banks, away from public exchanges. It's a financial shadow world. While reforms after 2008, like the Dodd-Frank Act, tried to bring more of this trading into central clearinghouses to increase transparency, a huge portion of it remains opaque. Think about it. A complex web of contracts, crisscrossing between the world's largest financial institutions, with each contract's value dependent on another, and another, and another. The exposure is so tangled that even the banks themselves don't have a complete picture of their total risk. A report from the Office of the Comptroller of the Currency showed that just 4 large US banks hold the vast majority of these derivatives. The concentration of risk is terrifying. The system is designed to be stable until it's not. It works as long as everyone trusts that everyone else can pay their debts. But what happens when that trust evaporates? A single major event, a sovereign debt default, a sudden spike in interest rates, a geopolitical crisis, could be the trigger. One major player failing to meet its obligations could set off the chain reaction. A mispriced bet, a computer glitch, one wrong move, and the shock could ripple through the entire financial structure in minutes. It would be a contagion event, far faster and more devastating than in 2008. Credit markets would freeze instantly. Banks would stop lending to each other and to businesses. Currencies could collapse. Stock markets would go into free fall. It wouldn't just be a Wall Street problem, it would be a Main Street catastrophe on a global scale. The scary part is, we don't know what the trigger will be. In 2008, it was US subprime mortgages. What could it be next time? Leveraged loans to corporations, European bank debt, an emerging market collapse? The problem is that the potential triggers are everywhere, and the financial weapon of mass destruction is already armed and aimed at the heart of the global economy. This isn't about fear-mongering, it's about understanding the fragile foundation upon which our modern financial world is built. It's a system of immense, hidden leverage, and it's larger and more interconnected than ever before. The next time you hear about a financial crisis, remember that the headlines might focus on stocks or bonds. But the real chaos, the real systemic risk is likely unfolding in the shadows of the $600 trillion derivatives market. Did you know there's a ticking time bomb at the heart of the global financial system? It's not stocks, bonds, or even real estate. It's something far bigger and more opaque, the derivatives market. We're talking about a staggering $600 trillion. To put that in perspective, that's more than 6 times the entire world's economic output. It's a mountain of interconnected bets, where every contract is linked to another. If just one major link in this colossal chain snaps, the shockwave could spread across the globe in an instant, triggering a collapse that would make 2008 look like a minor tremor. After the 2008 crisis, we were promised change. Regulators vowed to bring this shadowy world into the light with tighter rules, more oversight, and complete transparency. But has that really happened? The hard truth is, not much has changed. The vast majority of these complex derivative trades still happen over the counter, directly between massive financial institutions, far from the public eye. It's a system that runs on trust, complexity, and a dangerous level of denial. We've seen this movie before, and we know how it ends. When these high-stakes bets go wrong, who foots the bill? It's not the banks that created the mess. It's you, the taxpayer. Remember the 2008 bailout? The US government committed an estimated $29 trillion in loans and guarantees to prevent a total meltdown. That was nearly double the size of the entire US economy at the time. A truly mind-boggling sum. And yet, here we are again, staring at the same fundamental problem. The players may have changed, and the products might have new names, but the underlying structure is identical. We have massive amounts of risky leverage, shockingly minimal regulation, and a quiet, unspoken guarantee that if everything blows up, Governments will have no choice but to step in and rescue the system once more. But this time, there's a critical difference: scale. The sheer size of the derivatives market today is so immense that it could easily overwhelm the ability of central banks to contain a crisis. We're talking about a liquidity crunch so severe that no bailout package, no matter how large, could possibly cover the losses. Imagine a scenario where the dominoes start to fall. It could be triggered by something as simple as a sudden spike in interest rates, the unexpected default of a major bank, or a geopolitical shock that sends panic through the markets. The fuse would be lit. The financial system would seize up almost overnight. Credit markets would freeze, making it impossible for businesses to operate or people to get loans. Currencies could collapse, and retirement savings held in pension funds could be wiped out in a matter of days. This isn't just speculation or fear-mongering. This is simple math. The numbers are right there for anyone to see, and they paint a very clear picture. The experts who understand this system are issuing stark warnings. The question is no longer if. The next great financial crash will happen, but when it will happen, and whether our governments and institutions are prepared for the fallout. Given the current structure, the answer seems to be a resounding no. The foundation is cracked, the leverage is higher than ever, and the world is holding its breath, waiting for the first domino to fall. Thanks for watching. If you found this information valuable, please like this video and subscribe to the channel for more deep dives into the topics that truly matter. Stay informed and stay safe.